Welcome back to another episode of Palisade Radio. I'm your host, Karem Mutlu. And on today's show, we welcome back Barry Dawes, who's the Executive Chairman at Martin Place Securities. How are you today, Barry?
I'm just fine, Karem. Thank you for the opportunity of speaking to your audience again.
5 months ago, in our previous interview, we talked about how you position yourself within a market and a general overview of your investment framework. And for you, Barry, part of this framework involves looking at capital flow. So for you, is capital flow now starting to head back towards gold and silver from your perspective? And if it is it starting to arrive from retail clients rather than institutions at the moment? Or are the recent moves for precious metals still met with much skepticism?
Oh, look, I think we're seeing a bit of everything here. The flow is into gold, and there are many reasons for it, but gold has been the major recipient, and it's only now where we're seeing the flow through into silver. Now, it's interesting. I like to think that silver and the small cap resources companies are being bought essentially by the same market participants. Not in every case, of course, but it looks as if it's a good proxy, or they're all a good proxy for each other. So when silver's doing well, the small cap resources in the gold sector will do well. And I've been particularly interested in watching the Canadian TSXV and the way that has really underperformed, but it's just starting to show a bit of life. And that Canadian North American market is very, very important in gold and gold stocks all around the world.
It would be interesting to talk about the differences between the Australian ASX market and the Canadian US equivalent, and how investors are positioning themselves within either. Because the bear market for gold companies finished earlier for the ASX markets, and the gold price in Australian dollars is back towards its all-time highs, have the ASX companies essentially begun the move earlier and faster than the Canadian juniors, or is there no real difference?
No, they certainly did. Now, by my way of assessing things, the important gold stocks in Australia bottomed in June 2013. Now, that's 6 years ago. And the gold index, the Australian Stock Exchange gold index, bottomed in November of 2014. Now, the North Americans bottomed essentially very late 2015, early 2016. So the Australian companies were moving upwards long before their international peers. Now, the main reason for that, I believe, is that the Australian companies are better managers at the sort of small to intermediate level. And some very interesting things have happened in Australia. First of all, we've gone from being predominantly open cut mines to now predominantly underground, and we get about 75% of our gold production from underground mines. Now that means that we're often looking at higher grades, and it means that the companies can be growing their production and reserves while getting a good margin. Now, I don't consider that the A dollar against the Canadian dollar, for example, has been that different to mean that the Australian companies have been successful because of the lower currency. You know, I don't think that's right. I think that the Australian underground mining industry is now by far and away the world leaders, and Northern Star fits that very, very well. And when you see what they've been able to achieve with Pogo in Alaska, far better productivity, better mining operations, and really shaking up that industry. And I'm seeing it in other parts of North America where Australian ideas are coming in. So I think that they're better managers of these operations. They're more entrepreneurial, and they're freer to do these things, and they're just more dynamic. So So I think that's really been the driver. And of course, when we had Northern Star and Evolution buying these assets from Barrick and Newmont and other players who were leaving Australia, they were able to have the vision to see where the continuation of the mineralisation in places like Jundee and Kanowna Belle and Cowell for Evolution, that they've been able to see that and just run the things better because the people are driven. They're not people who've been employed by a big organisation from North America and Australia's a hardship post or whatever, and they just want to serve out their time before they go back to the big smoke. So I think these things are very, very important in understanding the driver. And also the general psychology of the Australian junior market is that the guys want to build mines, that they want to be known for the mines that they found, explored for, found, discovered, and developed. That's what drives them. So we end up with a very different mentality to the sort of North American model where people really are just trying to improve a particular operation and then sell it to someone else, some bigger player, to go along with. And so it's a different mentality.
Before the call, Barry, we were having a brief discussion about the nickel market, and as of today, on the 3rd of September, it looks as though the nickel price is breaking out. So does nickel look like it's back in a bull market to you? The recent export ban from Indonesia has led certain analysts to suggest that there are going to be major supply restraints for the nickel market at a time when demand from batteries via electric vehicles are heading towards a higher nickel density, and all of this is starting to ramp up. So what are your thoughts on nickel, Barry?
Look, I think you're absolutely right that the bear market in nickel broke a year or so ago, and over the last of 12 months, we've seen quite a strong move by nickel, and it just reflects the demand for nickel metal as opposed to nickel units. As we know, the stainless steel market makes up 65% or so of total nickel unit demand. But with these nickel chemicals that are important in the EV batteries, that big overhang of nickel metal that built up and was of no interest to the stainless steel industry is now being absorbed and run down and now is very tight. So I think that we're going to see good prices for nickel for quite some time yet. Now, I've got a general view that we're in a major bull market for commodities, and it's been very interesting that iron ore might have been the most unlikely of these commodities to begin the bull market, but it's leading things. And I've been quite bullish on iron ore for a number of years because the demand, not just from China, from the Middle East and from India, is just growing. And with the problems we've had at Brazil, it just exacerbates what is really a strong demand-led market. It's not a supply-restrained market in my view. It's more a demand thing. So I see gold has moved up and is following all that. Nickel is probably the next important one coming through. I would have expected copper to be a bit better than it is, but I think that too will be stronger as we go through the next couple of years, and I think the next 12 months, maybe even the second half of this year, we'll see a much better copper price.
I think it'd be interesting to get an overview on the electric vehicle space, Barry. Do you believe that we're going to reach a tipping point for EVs in terms of cost parity when compared to buying a petrol equivalent? As it appears, more car companies are now starting to invest within the infrastructure that's needed for charging points and to make adoption generally smoother for a new customer who is thinking of buying an electric car for the first time. And we've just talked about nickel, so also give us an update on lithium. How do you view that market?
Yeah, well, look, being a geologist and a history buff, I just can't go along with the concept of climate change and global warming and that stuff. And so I really feel that electric vehicles are built on a poor premise. But having said that, they're becoming more and more popular, and they will become significant as a total share of motor vehicles over the next decade. But the big thing, I think, though, is the lithium battery, which can be used everywhere in all sorts of household uses and industrial uses. And so I think we're going to see a lot of development in lithium batteries for all sorts of applications. And so that will bring good demand for nickel. The cars, I think, are just going to continue with their own momentum, and that basically means very, very strong demand for copper as we go through the next 5 to 10 years. So, even if we find electric vehicles only a modest portion of the total, the demand for the metal, I think, will be the metals, that is the nickels and the coppers in particular, will be quite robust. And overprinting all that is the lithium. Now, short-term, lithium does appear to be suffering from the issues of a lot of hard rock material coming onto the market, and that is a product which doesn't quite have the quality control that you have on the brines, and consequently you've got to be thinking of the people at the other end, and they're getting concentrates. What do you mean, concentrates and whatever, which have got a broad range of impurities in them, and it becomes very, very difficult for an end user to take a variety of materials or try and blend them and to get through to the lithium carbonates or lithium hydroxides or whatever product they want to use. On the other hand, with the brines, you end up with a much purer product which is easier to handle and more consistent into any battery manufacturer. So there are those things to think about, and in the short term, I think that's put downward pressure on lithium prices. But once we get through this little valley, and I think this valley will be crossed in this second half of 2019, and going forward, I think the markets will tighten up and prices will improve, and people will be a lot happier with the input materials into battery, and they'll battery manufacture it, and they'll have more control over what they can produce.
Fantastic. Okay, Barry, I think it'd be very interesting to understand a few key books that have helped shape your investment outlook over the years and why these books are important to you. Can you name a couple for us?
Well, I think Winning on Wall Street by Peter Lynch was one which I really enjoyed very early in the piece, and certainly Sir John Templeton wrote a lot of things, and the thing that I always like about Sir John Templeton is his comment that bull markets start in pessimism, rise in skepticism, mature in optimism, and die in euphoria. And if you think about that and think about human nature and where we are in all our markets, it gives you a much better understanding of the psychology of the markets and why things are doing what they're doing. So those sorts of things have been really, very helpful. Paul Johnson, who's a historian, a bit controversial at times, but I've loved some of his work, which pointed out the follies of government and politicians, and how we can go through periods in history where the narrative is falsely based, and we can talk about just rubbish and things that are fundamentally wrong, and as a result of that, they will affect the markets. But I worked with Marty Armstrong about 20 years ago, and I really enjoyed his take on markets, and he just taught me to try and think differently. Look at the markets, try and work out what they're telling you, and don't get carried away with the gossips that you're hearing on TV or reading in the newspaper. And I say to my clients, heed the markets and not the commentators. Work out what the markets are doing, and you need to look at a lot of markets to work out what's happening there. Don't just listen to someone who's pontificating about his particular view of the U.S. economy or the bond market or currencies or gold or whatever. You really have to put it all together and see what all the various components are telling you to give you that total view.
Okay, as we begin to wrap up, Barry, what would you say to investors who look at gold and silver today and worry that they've missed out? Do the miners and metal prices have a far higher climb ahead of them, in your view?
Oh, look, I think gold's got a lot more to go, but it's most important that people look at it in the different currencies. Now, it's really interesting that in $8 we've got record high, and I think there's about gold is in a record high in about 80 currencies, but it's not in US dollars, it's not in Indian rupees, it's not in Chinese yuan, it's not in many of the Middle East currencies. It's not quite there in Swiss francs. It is in euros. It is in Canadian dollars. It is in yen. So we've got to look at how the gold price is moving in those currencies. And when you look at them and their chart patterns, you can see, well, we've got a long, long way to go. And you can see that some of the small currencies have seen a skyrocketing gold price. So really what it says to me is that we're only just starting with the gold bull market in the big currencies. So when we start looking at bullion, and I think most people should have some bullion, whether it's gold or silver. Silver's going to, in my view, going to outperform gold over the next 4 or 5 years because it's at an extreme level. But like I was saying before, that silver and the small resource companies tend to be behaving similarly, and so you might have been lucky enough to stay in the Northern Stars and the Newcrests in Australia, which have done really, really well. And then you might have been able to pick up the leaders in the North American market with Barrick and Newmont and Agnico Eagle and a few others. But and those North Americans have been much later than the Australian companies. I don't think either group is expensive, because I think that the high gold price is going to throw off a lot of dividend cash for all these companies. But when you look at the mid caps and the small caps, we're really only just starting. Now, what I think is a very, very important point is that I did 13 IPOs in 2013, and I've only done 2 IPOs since, and neither of those were in the resource sector. I'm now starting. I've got my first IPO. Now, I think this is very, very significant, and this is basically a sign, in my reading of the market, that people will buy this stock, and they are coming into the market. The small end will give people outstanding performances.
Always a pleasure having you on the show, Barry, and I'm sure we'll have you back on the show later in the year.
Okay, thank you very much for the opportunity.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?